So I'm now going to introduce Alan Wood, Global Head of Business Development for Jersey Finance. As Global Head of Business Development, Alan is responsible for overseeing the promotion of Jersey as a leading international financial centre across key strategic overseas markets, including Africa, the Gulf region, Greater China, the US and the UK. Alan joined Jersey Finance in 2015 as Business Development Director before being promoted to Regional Head West, where he was responsible for overseeing the Africa, US and UK markets. Alan, thank you very much.
Thank you very much, Rupert, and good afternoon, everybody, and a very warm welcome to this Jersey Finance panel session. I'm just going to start by saying it's wonderful to be back at AFSEC, a conference that we've supported for many years. I remember the Brighton days when it was very small, so well done, Rupert, for driving it forward in these difficult times. Now, if you're interested in fund domiciliation and capital raising from a fund management perspective, and particularly from a South African fund management perspective, then this is the session for you. As Rupert said, my name's Alan Wood. I'm the Global Head of Business Development at Jersey Finance, but before I was appointed to this role, I spent 5 years in Africa, driving the Africa agenda, so particularly South Africa, Kenya and Nigeria, and like you, can't wait to get back to the continent, hopefully early next year. By way of background, Jersey Finance is a non-profit organisation that works in partnership with the Government of Jersey to promote Jersey as a well-regulated, internationally cooperative jurisdiction. 2021 marks the 60th anniversary of Jersey's modern financial services industry, where we first began to export financial expertise and intellectual capital around the world. It's also our 20th anniversary as an organisation, which is again a very important milestone for us. Jersey is today a custodian of 1.4 trillion of capital, that's in pounds, and we facilitate about 500 billion sterling into the UK and 200 billion euros into Europe. And the challenge for us is how do we channel more of that capital into Africa over the coming years? Jersey's relationship with Africa is very broad from a political, commercial and cultural perspective. Over many decades, Jersey has built a strong connectivity with Africa by supporting both inbound and outbound investments for both private and institutional investors. Our promotional work has generally been in the three big economies, being South Africa, Kenya, Nigeria, but Jersey does Pan-African business. Back in 2014, Jersey commissioned an independent study, Jersey's Value to Africa, to look at the contribution that Jersey could make to Africa's development and whether international finance centres could be a catalyst for growth in developing markets. The report found that over the next 30 years that Africa would need 85 trillion US dollars for infrastructure, machinery, buildings, homes, and the report indicated that there would be a significant amount of FDI required. At the time of the report, Jersey already facilitated 15.5 billion into the continent, into countries such as Kenya, Uganda, South Africa and Egypt. And the report argued that Jersey could provide African nations with much needed access to capital to help with economic growth and job creation. In our rapidly evolving global markets, the choice of fund domiciliation has become increasingly important for both investors and fund managers looking for efficiency, stability and transparency. That's why Jersey Finance commissioned African Business Magazine to deliver an independent study to understand the emerging trends for fund domiciliation and capital raising from a South African fund management perspective. Now that's enough from me. We've got some excellent content and some great speakers. So the rest of the session is going to be split into three quadrants. So the first one, Dr. Desne Mezi, who is the Head of Strategic Advisory at African Business Magazine. Desne is the author of the report and will deliver an overview of her findings. Unfortunately, she couldn't be here today, so we will be playing a video shortly. And then we'll hand over to Elliot Refton, who is the Head of Funds at Jersey Finance. And Elliot will talk about the funds proposition, and that will lead nicely onto the panel discussion, which Elliot will introduce. So we're just now going to play the video. Thank you very much.
Welcome to AFSEC 2021. It's great to have everyone back. Unfortunately, I can't be with you today, but thanks so much for listening to our panel, South African Fund Managers trends in fund domiciliation and capital raising, which African business we've done together with Jersey Finance. I'm Dr. Desno Marcy, I'm the author of the report, and this research is actually a development on from the 2015 report, Jersey's Value to Africa, where the opportunity to facilitate capital flows to the continent was explored at a macro level, and also from Jersey Finance's 2019 report commissioned from IFI Global on fund domiciliation. In this report today, we aimed to go more granular and unearth pragmatic market findings for funds and investors to make these aspirations around the Africa opportunity and wider global capital flows a reality. Even though starting from a low base, the opportunities for capital raising in Africa are substantial. The past 2 years have seen unprecedented capital commitments to Africa and foreign direct investment as the region becomes more economically and politically strategic. In September 2018, both China and the EU committed substantial sums to Africa. China pledged $60 billion to African partnerships, the EU pledged $45 billion, and the UK, alongside an ambition under Theresa May's premiership to be Africa's biggest G7 investor, pledged $5 billion foreign direct investment commitment as part of its global Britain strategy. And with the Western moral panic over China's role in Africa, the role of Japan's not insubstantial influence is often overlooked. In African Business Magazine, we found the Japanese overseas development assistance to sub-Saharan Africa in 2018 comprised 15% of Japan's total global spend, with commercial FDI at around $9 billion in 2018. And not to be left behind is Russia, which announced ahead of the first Russia-Africa summit in October 2019 that its commitments to the continent had quadrupled to $20.4 billion since 2015. We will also see increased investment flows from the Biden administration's commitment to impact investing under the DFC. There is definitely a role for international financial centers, or IFCs, to play in extending their financial expertise into these investments alongside institutional investors in a cost and tax efficient setting with support from development finance institutions. This is the driving rationale for this research. We wanted to get a sense of how this capital can be deployed alongside current trends in capital raising and fund domiciliation. When I first did this research, I was struck by how increasing political turbulence around COVID-19 was driving investors to safe havens. And then developments under the US with Trump's exit and the turbulence around the Capitol Hill just before Biden's inauguration, and also Brexit has proved a lot more tricky than what we thought. We will see that more stable jurisdictions like Jersey will have a very important role to play. And all of these reconfiguring geopolitical and economic concerns is also reconfiguring Africa's place in the world. And this is one of the things driving its rapid ascendancy. One important consequence of Brexit and what we experienced under Trump, it's brought home some inconvenient truth that political risk is not idiosyncratic to Africa and so-called emerging markets, but rather that they are features of markets everywhere. Suddenly, Africa's high-yielding opportunities don't look so risky anymore from a Western perspective. South African fund managers are ahead of the curve with these opportunities, and the past 2 decades has seen South African private equity expertise facilitate investment into retail, consumer, real estate, and infrastructure sectors around the African continent, typically partnering with DFIs from the UK and Northern Europe, but also with investors in South Africa, the US, and Asia to drive economic development with often spectacular returns. With this backdrop, let's go now to the report. Our research design used a methodology incorporating semi-structured interviews, and we compiled a snapshot in both qualitative and quantitative dimensions. As you will see, the sample comprises over 60 C-suite partner-level executives. The majority were fund managers of private equity firms with a connection to South Africa, but we also spoke to some traditional asset managers running alternative private market strategies or international vanilla equity portfolios to provide geographical diversification for private wealth investors. On the investor side, our sample is taken from all around the world, as South African fund managers are raising capital globally. Given the impact nature of these investments, the majority of funds raised from DFIs and family offices in Europe and the UK, and a smaller components were raising in the US, and even fewer were raising in Asia. For this reason, our investor sample is taken from EU, UK, and US, comprising mainly DFIs. Let's look now to the overview of the report findings. Our survey looks at the drivers of fund domiciliation and capital raising from many dimensions. First, we find that the choice of jurisdiction ultimately rests with LPs. Among LPs and the DFIs in particular, situated in the US, UK, and EU, 100% of capital is invested internationally, and given the substantial war chest of such investors, their portfolios are not limited to Africa. These preferences are set out in this slide showing the LP jurisdictional spread. We can see here that LPs have no particular preference to using a particular jurisdiction, provided the level of governance and regulation is sound with no major red flags. That being said, there remains some resistance among EU investors against IFCs, particularly with a push for sustainable finance, but well-governed IFCs should communicate those governance credentials carefully and actively to such investors. However, for the typical South African private equity fund investing into Africa, many LPs have traditionally used Mauritius for that geographical context, and this has been the status quo for many years. That, though, was complicated by Mauritius having been on the blacklist at the time that we did the research. And the government there is trying to solve that, but it has really also reconfigured capital flows for those traditional investors into Africa. The results of the GP survey on jurisdictional spread are shown in this next slide. Among our GPs, our sample had around 60% of their capital committed internationally, with the managers all having a connection to South Africa, but their funds or special purpose vehicles domiciled across onshore and offshore jurisdictions. We can see here that the majority, as I said, are in Mauritius, but also around 30 to 40% in Caymans and Sub-Saharan Africa, mainly South Africa, where many funds were raising capital as well, and a smaller subset of around 10 to 15% are domiciled in the EU, mainly the UK, Dublin, Luxembourg, and the Channel Islands. Opportunity here for investors to explore IFCs are very clear. In this first slide, we can see the LP drivers of domiciliation. The ultimate factors leading to the choice of jurisdiction is hence also LP-led, and this is determined by some key factors as set out looking at these drivers of domiciliation: familiarity, cost, tax neutrality, regulation and governance, and the quality of local service providers and non-executive fund directors. We find that of these, top of mind for LPs is the quality of the legal and regulatory framework. Given the industry trend focused on transparency through anti-money laundering or AML, know your customer, KYC, and substance provisions, resulting in increased regulatory reporting and costs only further exponentialized by the recent push for ESG, environmental, social, and governance factors to be incorporated into investment decision-making. This became mandatory for funds operating in the EU with the ESG disclosure regulation in March 2021 of this year. We also found that political and fiscal stability is also increasingly becoming a factor given the aforementioned geopolitical tumult I mentioned. In this next slide, we can see the GP drivers of domiciliation. We come now to our substance, which is described on this slide. We did not ask the LPs about substance as this was less relevant to them operationally, but for GPs as regards the 2019 EU substance provisions affecting domiciliation in BVI, Cayman, and the Channel Islands, the majority of respondents were aware of the EU push for this requirement, and the majority would add more employees if needed. However, one GP warned that if the provisions under substance become too onerous, requiring international offices and so on, that might force a review of using the applicable jurisdictions. Such continued trade-offs between regulatory complexity and cost are going to become more and more important for determining competitiveness. This is apparent in the mental model of value that I discuss next. In this slide, we can see the mental model of jurisdictional value. One respondent suggested that with increasing costs associated with reporting and transparency, it would become harder and harder for jurisdictions roughly in the middle of this continuum, like the Channel Islands and Mauritius, to sell their offering, as some funds and their investors would go for the gold standard of Luxembourg and Ireland, which also represents an increased level of regulatory complexity and cost. Or else a small majority would be open to light touch regulation on the other end of the continuum. This rough mental model was actually, as a result of a conversation with one of the respondents. And within this context, managers overall expect to use EU and offshore jurisdictions more, given the increased interest in impact investing by ESG-led investing, and crucially, a better understanding of the risks and opportunities of doing business in Africa. These intentions around future usage of EU and offshore jurisdictions are shown in this slide. For those South African managers who are already raising capital in Europe, the majority are using private placement as the EU Alternative Investment Fund Managers Directive, or AIFMD, are, in their opinion, inconsistently applied and incoherent for non-EU fund managers. Those who have tried and are raising would really like to see AIFMD become less draconian and more smooth for non-EU managers or some alternative solutions. In addition to these worries, low and negative rates across the EU was a major frustration at the time. Those have come up with inflation over the past year, but in general, they're still very low in comparison to Africa, and an offset with the high yields on the continent is quite important for those investors to consider. And this was supported by our findings and industry trends, which I will discuss now. We now go to the findings on the main industry trends in the context of this competitiveness. The main industry trends we unearthed were the dominant trend of increased complexity in reporting and regulation that I spoke about, and the costs associated with that. The rise of ESG, as I mentioned, and that's being pushed very actively by DFIs in Northern Europe, but increasingly seeing that private equity and hedge is also beginning to think about these issues. ESG and impact investing is raising awareness of the African opportunity. And the Cayman remains the most dominant for the US and Mauritius for Africa due to aggressive marketing from those jurisdictions. And low and negative interest rates and increasing costs of deals are not sufficiently offsetting high African yields. And political stability has become a concern, as I said, and we'll discuss that now in the macro findings. This next slide shows whether our respondents thought that COVID-19 would affect capital raising and domiciliation. We had some of these conversations, just as lockdown was really beginning to bed in. So roughly around June last year. And at the time, people had very mixed views on that, but these were Brexit and COVID-19 were the twin peaks of market volatility concerns. That remains the case. Brexit is a concern for those with exposure to the UK, and the pandemic was a hindrance for capital raising and fund exits, but we're seeing activity really pick up. Beyond these frictions, managers and investors remain wildly optimistic about the African opportunity. And while thought leadership to increase knowledge about the opportunity will allow investors and managers to capitalize on this, more practical arrangements, such as regulatory MOUs and double taxation agreements, will become increasingly important in the political economy of such deals. There's a limited window of opportunity to signal value and suitability to African managers, while Mauritius is sorting out its blacklist and governance issues. But this could also see competition coming from Singapore, which is also another leading jurisdiction for funds raising from Asia. And but certainly well-governed jurisdictions as Jersey can still distinguish themselves by quality, governance, and stability. As one manager told us, he never had a problem raising capital from the EU, US, or Asia using his Jersey structure. Thanks very much for listening.
Good afternoon. My name is Elliot Refson, and I head up the fund sector at Jersey Finance. In essence, the role of Jersey Finance is, on the one hand, to define the product offering of Jersey plc, and on the other hand, to tell people about it. I'd like to thank Desne for her excellent insight into the trends in fund domiciliation and capital raising for South Africa fund managers. To me, there are three takeaways of this report. Firstly, there are the ever-evolving and changing geopolitical uncertainties. Secondly, there are jurisdictional uncertainties, specifically around cost, regulation and governance. And thirdly, there is specific frustration around accessing European capital under the AIFMD regime. The choice of jurisdiction lies with investors, and the South African report clearly shows that the blacklisting of Mauritius and the openness to look at jurisdictional choice is underpinned by a demand for jurisdictions with a clear and established rule of law, a respected regulatory framework, as well as political and fiscal stability, all with a minimal change regulatory outlook. Against this backdrop, I thought it would be useful to spend a few moments to frame Jersey as a jurisdiction. In Jersey, financial services is the bedrock of our economy. Our default is stability, both political stability and fiscal stability. Further, we offer a minimal change outlook from a regulatory, legal, or economic perspective. We have achieved this, and we will continue to achieve this through the collaboration of our industry, our government, and our regulator, which has for many years led to innovation within a robust and globally respected regulatory framework, adopting international standards swiftly but pragmatically to maintain our global reputation. This base of stability and tax neutrality is supported by world-class infrastructure, highlighted, for example, by the fastest broadband in the world, and supported by broad and deep expertise from the 14,000 people who work in the finance industry. As a result of these factors, Jersey is recognized around the world as an award-winning international finance center of excellence, whose reputation and regulation is acknowledged by independent assessments from some of the world's leading bodies, including the OECD, IMF, and World Bank. So what does this mean in practice for our jurisdiction? Our primary focus in Jersey is the alternative investment fund sector, and 90% of all Jersey funds fall into this category. According to the 2020 Monterey report, Jersey AUM broke through the $500 billion barrier for the first time. This represents a growth of 66% over 5 years and 125% over 10 years. At the end of the second quarter of 2021, that figure was touching $600 billion, showing a year-on-year increase of 20%. In addition to this, there is around $1.8 trillion held in corporate vehicles in Jersey. Within this, South Africa continues to represent the 8th largest pool by country, and we continue to see inflows from there and other African countries. Turning to the specific point around European access raised in the report, it is also worth highlighting this key aspect of our regulatory regime, which is almost unique to Jersey, and that is our opt-in, opt-out approach to the EU AIFMD. Being outside of the EU means that Jersey is not subject to AIFMD when targeting investors from the rest of the world. Within the EU, Jersey has excellent, long-standing bilateral relationships with its member states and established market access arrangements via the national private placement regimes. These are immune to impact by Brexit. On the other side of the Brexit equation, Jersey's access to the UK is guaranteed under its agreement there. And in this way, Jersey bridges the gap between the EU and the UK. Since Jersey funds are out of scope of the full AIFMD, we are able to offer a more cost-effective solution, both in terms of the setup costs and the ongoing costs. Since Jersey private funds can be established within 48 hours, we are able to offer a faster time to market. And since private placement is simpler than passporting, we are able to offer a more efficient and targeted solution to those not based in the EU or the UK, or those looking to market on a pan-European basis. And with that, I have pleasure in passing you to my colleague Peggy Geelan, who looks after the funds area from a legal and technical perspective within Jersey Finance. Peggy.
Thank you, Elliot. That was an excellent presentation. We will continue on the same theme, and I would like to start our panel session by handing over to our panel and ask them to introduce themselves. Freddie?
Thank you, Peggy. My name is Frederick Holmes. I'm the Principal External Relations Officer at the Ministry of External Relations for the Government of Jersey, and I have primary responsibility for delivering the government's political and commercial relationships in sub-Saharan Africa.
Thanks, Peggy. Hi, I'm David Fowler. I'm Global Head of Private Equity at SAN. We are a fund administrator and corporate service provider specialising in alternative assets with offices in 23 locations globally.
Hi there, I'm Gavin Wilkins, Chief Commercial Officer at Hawksford. We are also a fund and corporate administrator. We also provide private wealth services globally.
Thank you. Freddie, in your role at Government of Jersey, you're ideally placed to talk to us a little bit more about the Government of Jersey's engagement with Africa and why the region is such an important market for Jersey.
Sure. So I think if we start with Africa as a key market, it will come as no surprise to anyone here today that the economic and socio-demographic indicators all point towards Africa becoming a more and more powerful player in the global economy. Economically, it's an attractive destination. We're seeing new value chains developing in tech, telecommunications, green energy, alongside the traditional sectors of infrastructure and extractives. Demographically, the median age on the continent is 18. That's 14 years younger than any other country on Earth. And we're seeing birth rates at a replacement level or higher than death rates. So I think it's certain that the African consumers and workers are going to be there for the future.
Definitely. Now, could you tell us why that is so important for the island's economy?
Sure. I think it's fair to say that traditionally Jersey's probably relied on its proximity to the UK and Europe for much of its trade. That's in financial services as well as agriculture. But we're starting to see these traditions change. I quote a recent EU report that suggests that 90% of global economic growth is going to come from outside of Europe by 2021. And so for Jersey to continue to position itself as an IFC of choice, we need to make sure that Jersey is known in Abuja, Pretoria, Nairobi, just as it is well known in London or Geneva. The government recognises that, and they've invested accordingly. My team is there to help deliver that growth and support Jersey's expansion in target markets. And out of 14 priority markets, 6 of those are in sub-Saharan Africa.
Yes, thank you, Freddie. Now, Gavin, opportunities abound for investors and managers alike. Could you tell us a bit more about where you see the most opportunities?
Sure, I think the opportunities are probably as diverse as the continent itself. I guess probably getting investors to focus on the opportunity or see the opportunity is less of a problem than the risk management side of things and turning those into investable opportunities. So it's not so much a question of alerting people to the opportunity, rather deploying the capital into opportunity. I think for me there, Jersey, the whole playbook of Jersey, corporate governance, stability, just lends itself to risk mitigation and to all of those components that help to create an investable opportunity. I think when we look at the fund side of things, we've got a leading Jersey private fund regime. I was listening to the CDC talk this morning when they were talking about private credit funds. That piqued my interest amongst other areas. But in terms of capital markets, Jersey is the leading jurisdiction for international companies for listing in London. The London Stock Exchange is open to Africa, and we come back to corporate governance, we come back to the strength of non-execs and the stability of the jurisdiction, and really, anything that can help as part of an overall proposition is going to be welcome to the investors, to the DFIs, and really that's what it's all about. Yes,
definitely. Now, David, where do you see the opportunities, and how well is Jersey placed to make the most of them?
Yeah, no, I mean, I would echo what Gavin said. Jersey's also ticking a lot of those boxes in terms of stability, governance, and strong and flexible regulation where required as well. I think the other point I would add is that educated and highly experienced workforce. Jersey benefits from having service providers, lawyers, accountants, fund administrators who understand these structures and really support clients in the best way possible. From our own perspective, we've definitely seen a number of opportunities coming through Jersey recently with funds investing into Africa, and it's interesting how it's come from sort of two very different investor bases. So we have recently been onboarding a fund which is investing across Africa with LPs who are DFIs from the US, Germany, and France. I think that, again, adds to the credibility of Jersey that institutional investors are very willing to use Jersey as a structure, and it's a feasible structure for that kind of caliber of investor. And then on the flip side of that, we've got funds where we've got African investors from high net worth or family offices who are also using Jersey as a structure of choice. So I think it's there, it's on the map, and it's got all those good things going for it, which provide that opportunities for investors to use Jersey as a structure.
Yes, excellent. Now, Freddie, David and Gavin have both highlighted a really important area, I think, for investors, which is a jurisdiction's ability to comply with international standards. Would you be able to give the audience an overview of Jersey's credentials in the area of transparency and governance? And also, how are you dealing with the pandemic recovery?
Sure, absolutely. So if I touch on Brexit very briefly, I'll, for the audience's benefit, I'll note that Jersey was never part of the EU single market in its own right, and we also didn't get a vote on that. But as the UK has begun to position itself post-Brexit as under the banner of Global Britain, so too is Jersey, and that's where some of the work that my team come in to do to make sure that Jersey is well positioned in terms of creating a positive visibility overseas in those key markets, making sure that we have the right access to those decision makers, be that in business or government. And then ultimately it's about how do we support the post-pandemic recovery by developing those business flows between Jersey and those partner jurisdictions. I suppose on the latter of those 3 points, the government of Jersey places great importance on its sort of network of international agreements to try and facilitate that greater trade. We look at two types of agreement there, the bilateral investment treaties and the double taxation agreements, and we saw the reference to those in the report earlier today. Collectively, we think that those two agreements together help provide investor protection, but also tax certainty for those future investors. And ultimately, they help deliver the FDI that is needed and which Jersey can provide.
Yes, thank you. Now, we've talked a lot about opportunities. What about challenges, Gavin?
Yeah, I think, probably came through in some of the sessions this morning. The challenge is probably deal flow and investable opportunities. So it comes back to that availability of the right kind of investment to flow through from international investment. So I think probably the challenges are there. The challenges are there in terms of corporate governance. The challenges are there in terms of making sure that your proposition is in the right space. So I guess the recommendation there would be to make sure that the longevity of the track record, the skills and experience of the management team are first and foremost, along with having put some thought into to the choice of jurisdiction and structuring in a way that supports and complements that overall proposition. I think investors are rightfully selective. There's still a lot of uncertainty out there, and it's all about making them see what you see in terms of the opportunity and the project that you're trying to promote.
Yes, yes, definitely. Now, David, what about what's your view?
I mean, maybe coming at it from a slightly different angle, I think, in terms of challenges for Africa, maybe also more broadly, but obviously COVID-19 has played a part in fundraising. So that has been challenging over the last 18 months, although that is now changing. So I think in terms of LPs being able to do diligence on managers, in terms of managers being able to do due diligence on investments in Africa, that has obviously been a challenge more recently. But I'll say that is moving on. I think also initially after sort of the original COVID-19 lockdown period, we saw a flight to more established managers with a track record. They were sort of having not so much issues in terms of fundraising, and maybe it was a bit more challenging for those emerging or fledgling managers. Again, that is starting to change, and so now I think with the advent of sort of more impact funds, ESG being a hot topic, it's been talked about a lot today. Africa is definitely a market open with Jersey as a structure.
Yes, yes. Now, Freddie, you've mentioned Brexit before, but could you give a bit more detail around Jersey's position for financial services on Brexit and any political and other relevant agreements?
Sure. So I think what is key to me here, and it's something that we've heard spoken before, is about the need for continuity. It's clearly a high ask for investors, whether that's in financial stability, regulatory stability, political stability, and I think that Jersey is well positioned in that regard. We've touched on the sort of two main commercial sort of international agreements that we try and use to help facilitate those trades. We also underpin those bilateral agreements with wider MOUs, so that's memorandums of understandings with partner countries that tackle a wide variety of issues, whether that's international development, conservation, tackling financial crime, for example, trying to create a more conducive business environment. I think Jersey is well positioned to provide expertise on those various bits and pieces. Again, we talk about sort of credentials. As Elliot touched on, Jersey's been rated by the IMF and the OECD as a highly regulated, compliant jurisdiction. I think that speaks for ourselves in terms of our positioning. Again, IFCs are coming under more and more scrutiny, and it's more and more important now for the governments of those IFCs to continually adapt and change to those regulations as they come in. And I think we have a proactive government in that case.
Yeah, so Dr. Maisie, she mentioned Mauritius, and I think, usually that is seen as the gateway into Africa. Now, what's your view on that, Gavin? And I mean, in comparison, how well is Jersey placed to win funds business specifically from Africa?
Well, I think Mauritius, of course, is part of Africa, and its proposition has been historically strong. I think there's been some recent challenges for Mauritius, but do I think Jersey will take over all the work that's previously gone through Mauritius? No, I don't. I think what you probably will see is a continued progression towards deployment of capital from large institutional investors into Jersey structures where the confidence is there in the corporate governance standards and the proximity, particularly where you're dealing with money coming from the City of London. I think you'll probably see more and more of that head fund capital raising and conduit into structures that will continue to use Mauritius and other jurisdictions in tandem with everything that Jersey has to offer.
Right. Yeah, David, is that what you're seeing as well?
Yeah, I mean, as we've seen in the report, obviously Mauritius continues to have the majority of both fund level and SPVs for investments into Africa. Obviously, there have been challenges with FATF. We may have updates on that in coming weeks, which may be good, maybe not so, from a Mauritius standpoint. But I agree with Gavin that Mauritius isn't going to go away completely, and Jersey's not going to take on the world either. So there's space for them both to complement one another. I think you're right, Gavin, at the pooling vehicle level, we're going to see more Jersey structures used, but I still see a place for Mauritius in terms of the holding companies and the SPVs, and probably some of those Asian investors will continue to use Mauritius and perhaps the likes of Singapore at fund level.
Yes, that's really insightful. Thank you. Now, we are running out of time for our panel session, but if I could ask each of you for 3 key takeaways for the audience, please.
Okay. So I think Jersey is well positioned to provide access to capital for some of these target markets, especially in Africa. I think we are well positioned to provide investor protection, both through some of the international agreements that we touched on before, but also the financial and political stability that Jersey as a jurisdiction has. And then again, we're always looking for opportunities to provide support or work with partner jurisdictions on key issues, whether that's in governance and transparency, but also around tackling tax avoidance.
Okay, thanks, Peg. I think from my standpoint, number one, Africa is a booming economy that we're going to see continual growth from, be that because of the demographics, be that because of the innovation and the technology that we're seeing come through that market, and also because of the focus on ESG and impact investing, which will certainly benefit Africa as well. So that's number one. I think number two, we're certainly seeing that limited partners, LPs, are very conscientious of which jurisdictions they use for structuring, and that's going to become more and more important as GPs structure their funds. And number three, that Jersey is ideally placed as one of those jurisdictions of choice for such funds.
Great.
Number one, the opportunities are there. Number two, the capital is there. And number three, Jersey's proposition lends itself towards what both the investors and the managers are looking for, and Jersey is open for African business.
Well, I would like to thank our panelists for their excellent contribution today, and of course our audience for joining us today. Please grab your free copy of African Business on your way out, and if you would like to find out more about Jersey, please come and see us at our stand or visit our website jerseyfinance.je. Thank you very much.